In this video, I'm going to discuss how you can invest your money at age 60. What I'm not going to do is tell you what you can learn from a basic Google search. This is real world stuff, so stick around. So let's dive in. How can you determine an allocation for you? Maybe you've heard that retirees should have a 60%, 40% allocation between stocks and bonds. And while there can be a lot of truth to this generalization, why 60-40, and is that right for you? Here's how you can figure it out. If you're 60 years old and you're trying to figure out how to invest your money, the first thing that you need to do is figure out how much you need to grow your money by to fund your future spending needs. So in other words, what is the lowest investment return that you can earn on your money if you're trying to offset your spending by enough to ensure that you won't deplete your assets during your lifetime or achieve whatever your long-term goal may be with your money? To understand this, think of a portfolio that has no growth. Say you're age 60, you're spending 4% each year from your portfolio, and that spending is increasing with inflation by 3%. If there's no growth on that money, it will be projected to run out by your age 79. If you're a male, there's a 75% chance that you'd still be alive at this point. And if you're female, there's an 87% chance that you'd still be alive. So most people need to take on some level of risk to meet their goals. The question is, how much? And the amount of growth that you need on your money is what's going to tell you this. The greater your growth needs, the greater amount of riskier investments that you'll need to own as a percentage of your total assets, like stocks, for example. So let's build from this using the same example from before. Say you're age 60 and you're going to need to spend 4% a year from your money, and that spending is going to rise by 3% a year with inflation. In this case, if you'd like to die with the same amount of money after adjusting for inflation, then you need to grow your money by 7%, or 4 plus 3%. But since the typical retiree is probably less interested in dying with a lot of money and more interested in just not running out of money during their lifetime, then this required return would more likely fall somewhere between 4 and 7%. We'll call it 6% to get their money to last at least into their mid to late 90s. So if 6% is your growth need, what allocation may be likely to achieve this? Well, it's going to depend on the potential future return that you can earn on the investments that you're considering. A lot of firms in the business of predicting things will actually publish their expectations based on their research. And of course, nobody knows exactly what's going to happen, but this is at a minimum an educated guess. So looking at BlackRock's long-term assumptions, you can find this on the web, by the way, they expect that U.S. stocks may earn average annual returns over the next 2 decades of around 7.2%, and for foreign stocks around 8.1%. So if we're assuming a globally diversified portfolio with roughly 60% in U.S., 40% in foreign, this expected long-term annual return might be somewhere around 7.6% for stocks. They also expect diversified bonds will earn a long-term average return of around 4.3%. So if stocks earn 7.5% and bonds 4.3% on average over your horizon, the lowest risk that you could accept to achieve a 6% growth rate or 6% return would be roughly 55% in stocks and 45% in bonds. So that's how you think about how to allocate your portfolio, but it's just the first step. Now you need to figure out if you can afford to accept this level of risk. And if you can't afford to take this much risk, then it would be wise to adjust your goals. There are 2 things that determine your capacity for taking risk when investing your money. The first is your liquidity needs, and the second is your willingness to experience fluctuations in the value of your money. Your liquidity needs are just a fancy way of describing how much income that you'll have to withdraw from your savings over the coming years. If you're going to need to withdraw any recurring amount from your savings that amounts to, say, more than 2 to 3% as a percentage of your total financial assets annually, then your liquidity needs are generally considered to be high. Your allocation to stuff like cash and short-term bonds in this case should at a minimum satisfy 5 years or so of your spending needs. You're otherwise accepting too much risk because you may be put in a spot where you'd have to sell your investments at a loss just to meet your spending needs. Your willingness to accept risk is a bit trickier because it's more subjective, and your attitude toward risk will evolve over time. For example, as we retire, we tend to grow less willing to accept risk as our lifestyle now depends on our money. The ultimate goal here is to accept a level of risk and uncertainty that both eliminates your likelihood of making a hasty decision decision during a down market and reduces your overall anxiety to a level that you're willing to accept. So now you have an idea of the framework used for determining how much to allocate across different types of investments like stocks and bonds. How do you select the specific investments within those asset classes? Let's begin with the bond side of the ledger. For a 60-year-old, I'm a big fan of carving out a bond ladder using individual bonds to meet at least 5 years of upcoming spending needs. This doesn't mean the bond money will be spent, but it's more of a strategy to insulate you from market-related stock and interest rate risks. So if you're not familiar with bonds, they're a type of fixed income investment that will typically offer investors a lower potential return compared to stocks, but with much less downside risk. They're also more predictable. When you buy a bond, you get paid a rate of interest, and then you receive your money back when the bond matures. The reason why I tend to suggest that 60-year-olds carve out a portion of their money or their bond money to purchase an individual bond ladder is because both bonds and stocks fluctuate. But when you own an individual bond, interest rate risk, which is when bond prices fall, when interest rates rise, it's irrelevant so long as you hold each bond until its maturity. So if stocks and bonds are down in value and you need cash for spending, the bond ladder offers you a regular source of liquidity without having to sell off your investments at a loss. If markets are generally up, you can always take the regularly ongoing maturing bonds in the ladder and redeploy them to the end of your ladder. I even take it a step further and focus exclusively on certificates of deposit and treasury bonds for the individual bond ladder. And the reason for this is because they both have guarantees of principal. The protection for CDs is limited per bank, but they have insurance by the FDIC, and treasuries have the guaranteed principal by the federal government. For the rest of your bond money, 60-year-olds can choose to invest in more diversified investments like bond mutual funds or exchange traded funds, or ETFs is what they're the acronym for them. These types of products will tend to be a bit more volatile than the short-term individual bonds that we were just kind of talking about, but they also offer you the potential to earn some extra return because the funds will tend to own some bonds that have longer maturities and pay higher yields, or they have higher credit risk. Bond funds come in all sorts of shapes and sizes, but for retirees, I'm a big fan of total return bond funds that seek to manage those interest rate related risks that I was talking about and try to benefit from changes in the economy. This isn't without risk of the manager not being able to execute, but I would consider these types of investments to be longer term in nature anyway, especially if you already have your shorter term needs covered with the bond ladder and emergency savings fund that we were just going over. Other types of bond funds could be core bond funds that may be more closely resembling a diversified index but try to outperform it by a bit, or even an index bond fund that simply tries to match the index, which is a big basket of bonds. All of these can be good choices for a portion of your bond money that's less important to your near-term spending needs. Now, when it comes to the stock side of the ledger for 60-year-olds, I'm a big fan of dividends and exchange-traded funds, or ETFs. Again, I said that was the acronym that you may be more familiar with. Dividend growth stocks in particular would be companies that have historically increased their dividend over time. Many of these companies tend to have other quality characteristics that may lead to lower downside risk over time without costing too much in terms of upside potential. I also think that most people, including retirees, should have a portion of their savings in ETFs or mutual funds that match broad market indices like the S&P 500 or the MSCI or the MSCI EAFE. One of the great debates of personal finance is, why not just stick all of your money in the S&P 500? After all, there are a few diversified investments that have outperformed the S&P over time. But I would push back on that sincerely. And the reason for this is that the S&P 500 may be diversified in the United States, but it's geographically concentrated, and its structure can also cause it to become over-concentrated during periods of excitement and very strong returns from a handful of companies. This has historically led it to underperform significantly for prolonged periods of time versus other areas of the market that are focused in other areas of the world or by style. For example, in the years following the dot-com bubble, you had a decade where the S&P 500 made no money, while foreign and value stocks at least produced positive returns in the mid-single digits. The timing around this type of potential underperformance can be a major consequence for those who are planning to spend their money soon. I don't want you to think that I'm knocking the S&P 500 because it has outperformed and it's been a great investment over the long term. But that doesn't change the fact that we don't know the periods of time that will have the greatest contribution to this outperformance in the periods of time that will detract from it. So as it relates to buying passive investments that track the performance of major indices like the S&P 500, I think that most 60-year-olds should own them. I just don't think it should be your entire stock exposure. Regardless of how something performs relative to other investments, diversification is and will always be the most important principle of successful long-term investing. This is especially true for 60-year-olds who will soon be spending down their money. I hope you found this video to be helpful. If you feel that you'd benefit from a review of your investment portfolio, your investment strategy, or just simply want to look over your financial situation, there's a link in the description of this video that will bring you to my calendar to schedule a call with me. I wish you the very best of luck, and I hope to hear from you soon.